Have you ever thought about how you're going to be penalized for saving, especially in retirement, or that you might actually get double taxed? Well, this is what happens when you've saved really well for retirement and you forgot about how things are going to be taxed. So, one of the things that Jack said to me after one of the educational classes I did, he said they had everything figured out. He had his Social Security, had his pension, and a solid 401k. But what he didn't realize was how much of that money would eventually be taxed, whether he liked it or not, or whether he needed to spend it or not. Here's the reality. The U.S. is aging fast. In 1970, only 10% of Americans were 65 or older. Today, it's over 17%. By 2060, it will be nearly 25% of the U.S. population over 65. That means more people are relying on Social Security, Medicare, Medicaid, and all those programs already make up over half of the federal budget. Right now, the U.S. spends about $6.1 trillion a year and only brings in about $4.4 trillion in revenue to cover the expenses. So obviously, we have a $1.7 trillion deficit every single year. So where's the government going to find more money? You guessed it, taxes and fees. And that could mean higher taxes on your retirement accounts. So how do we avoid that? One thing you could do is Roth conversions, but often the big argument is if I have a smaller number growing or compounding, it won't grow as fast as a bigger number compounding. So let's look at the math. Say you have $100,000 in your IRA. If you convert it to a Roth today and you're in the 22% tax bracket, you'll pay $22,000 in taxes, leaving you $78,000 to grow tax-free. If you don't convert, your full $100,000 keeps growing tax-deferred. An 8% growth rate for 10 years, the IRA grows to about $215,000, and the Roth will grow to about $168,000. Here's what I mean by that. You can see that I have $100,000 growing for us here, and it's going to grow for 10 years, and then at the end of 10 years, I have $215,000. Now, if I have a Roth IRA, $78,000, it's only going to grow to $168,000. Not good, right? However, let's look at where things might break even here. Looks like the Roth lost. But remember, the IRA still owes 22% tax, which if you take 22% of the $215,000, that's about $181,000 after tax, almost exactly the same as the Roth. Looks like the Roth lost, right? But remember, the IRA still owes taxes at 22%. Now it's back to $168,000, the same amount as the Roth IRA. So the Roth and the IRA are basically exactly the same growth, same taxes, same result. But here's where it gets interesting. Once you turn age 73, the government says you must start taking money out of your IRA. That's called required minimum distributions, or RMDs. Now, if you don't need the money and reinvest it, you're putting it into a taxable brokerage account. That money keeps growing, but it's now taxed again. The interest, dividends, capital gains, all are taxable. Meanwhile, the Roth IRA keeps growing tax-free. No RMDs, no 1099s, no capital gains tax. That's where the Roth starts pulling ahead. If you've saved more than $750,000 or $1 million more in pre-tax accounts, this really starts to matter because bigger accounts mean bigger RMDs. And bigger RMDs mean bigger taxes, higher Medicare premiums, and possibly higher taxes on your Social Security. So yes, a larger number grows faster, but when it's taxed multiple times, that advantage disappears. So Roth conversions aren't about today's math. They're about tomorrow's taxes. If you want to see how a strategic Roth conversion could help you keep more of what you've worked hard for, check out the link below. You can schedule a free tax conversion mapping session with me or my team. Remember, it's not about how much you make, it's about how much you keep. If you like this video, make sure to like it and subscribe and send to your friends that might also learn something. We'll see you next time.